Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 13th of May. I'm Daniel Lam, your host for the podcast. Yesterday, we spoke about how the US dollar has been lagging in the recovery in global risky assets, and that the DXY can reach the 103 resistance level in the near term. Now, I want to elaborate further that there is reasonable risk-reward in going long US dollar for the very near term, because this has been one of the sharpest US dollar sell-off that we've seen since the start of any US cross-asset drawdown in recent decades. Now, what is the concern about a structural US dollar bear trend? Now, typically, that has two common features. The first one is ongoing US economic underperformance relative to the rest of the world. And secondly, persistent US equity market outflows. Now, regarding the latter, there's evidence of buying the dip by investors over the last few weeks. So that is unlikely to lead to sustainable US dollar weakness. There's usually a corrective bounce when momentum behind the initial US dollar sell-off phase and speculators unwind their bearish trades. Positioning of momentum investors show that we are close to some key stop levels from them, and there is a good probability that we will see a short squeeze on the US dollar. But over the longer term, the narrative in the US dollar has become a tug of war. Yes, the motivation of many of Trump's actions, such as tariffs, is to attempt to reduce the budget deficit and thus restoring investors' confidence in the US dollar. But in doing so, the uncertainties in US policies is leading to questions on any excessive positioning in the US dollar. Now, US dollar depreciation reflects a move by investors to reduce what had become a historical overweight position in the dollar. This overweight was reinforced as global exporters chose to keep their receivables in US dollar rather than repatriate or even hedge back to their home currencies. The question now is whether US dollar selling will continue. Has confidence in the US and the US dollar been weakened? Is there now a crisis of faith in US policy and institutions that would prompt a structural decline in the US dollar? All these are open questions. And the need for diversification explains the strong performance in assets such as gold. And we continue to see a demand for the yellow metal, because we believe that the US-China trade talks will still be protracted and complex. US policies will also stay unpredictable under Trump. So therefore, safe haven demand will not disappear completely, and that lends a floor to gold prices. Now, meanwhile, a tariff-induced growth slowdown should pave the way for Fed rate cuts in the second half of 2025, and that will offer support for gold prices. Softer prices would also re-accelerate central bank gold buying, which stood at 244 tons in the first quarter this year, which is below recent averages due to elevated prices, but still well above long-term history. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.